Charlie Munger, one of the best investors in history, has said that accumulating the first $100,000 from a standing start with no seed money is the most difficult part of building wealth. Making the first million is the next big hurdle. For most of us, it is difficult to see a clear path that will lead to $1 million investment account. How do you even get started? There's a good reason why Charlie Munger made this claim. For most investors, the first $100,000 takes a very long time compared to the next $100,000, and then the next. Why is this the case? The short answer is that you don't profit much from compound interest before you have a fair amount invested. In this video, we will deep dive and explain why the first $100,000 is so difficult and provide advice for how you can get there as fast as possible. Welcome to Investing in a Nutshell, the channel where we explain the world of investing so that you can learn and start your own journey as an investor. The first problem all of us face in the chase for the first $100,000 is to get started. How long did you or anyone you know talk about investing before they actually started? How many people have you heard say, "I will invest when I have more money"? That's like saying you'll put more wood on the fire once it provides you with heat. The first step is always the hardest. If you have a dream of becoming an investor, then start your investment journey today. Start with a small amount and then build good saving habits to make the investment account grow. Once you start investing, the main factor on how fast you can get to $100,000 is how much money you're able to invest. Finding amazing investments helps, but you do need to acquire most of the first $100,000. In order to achieve this, you need good saving habits. It's very easy to spend all you earn, both for someone with an average salary as well as those with a high salary. In order to save $100,000, you need to be frugal. In 2010, a book titled The Millionaire Next Door: The Surprising Secrets of America's Wealthy by the authors Thomas Stanley and William Danko was published. In The Millionaire Next Door, they found that most of the rich live frugal lives. To be frugal means careful use of one's money. You don't spend money unless it is something you need or really desire. If you want to become one of the millionaires, then you can't buy the car you don't really need. Avoid bad spending habits like going to Starbucks every day. You should not spend money to look rich for your friends, colleagues, or neighbors. You should instead invest the money and become rich. These are the two main steps needed to get the first $100,000 invested. You also need to find good investments that will make you a profit, and those investments will make the next $100,000 much easier. As we mentioned in the introduction, the main reason why the first $100,000 is so much harder than the next is compound interest. But what is compound interest? Compound interest refers to the fact that you will earn interest on the interest itself from your investments. Therefore, every year that the money is invested, you are earning interest on each previous year's interest. This means that not only are your savings growing over time, but that the rate at which they grow gets faster as well. We could see this in action by taking some basic figures. For example, if you deposited $1,000 at a rate of 10%, at the end of year one, you would have $1,100, equaling $100 of interest earned. The following year, you would earn $110 in interest, 10% of the original capital, and 10% of the year one interest. The next year would be $121, and so on. You might not be convinced. What is it that makes compound interest so powerful? Compound interest is powerful because even if you stop investing, your investment account can continue to grow. Over a long period, this can create a huge difference and explains why, when it comes to savings advice, so many experts will tell you to start saving early. If an individual was to start saving $100 a month at the age of 30 and continued until they were 60, they would have saved with 10% annual interest a sum of $217,000. However, if they started saving $100 a month at the age of 20, stopped when they were 30, and left the money in the account until they turned 60, they would have accumulated $367,000. The magic of compound interest in this example means that saving for 10 years can be more profitable than saving for 30 years, if it starts earlier. Keep this in mind in your chase for the first $100,000. Every expense you have will, in addition to the cost, also have an opportunity cost. A dinner out with friends for $100 will also cost you $10 next year and $11 the year after because of opportunity cost. If you skip one dinner at a restaurant every month for a year and invest the money, the investment will provide you with a free dinner at a restaurant once a year for the rest of your life. Depending on your investment returns, of course. We will cover opportunity cost and compound interest in more detail in a future video, so make sure to subscribe to the channel and press the like button. It really helps out the channel and enables us to reach more people and help them start their investment journeys. Compound interest will be your best friend as an investor once you reach and surpass the first $100,000. Most of the first $100,000 must come out of your pocket as savings, but the next $100,000 could come from investment returns alone. Let's explore with an example. Jill decides to finally start investing. She will invest $500 a month and put it all into an index fund tracking the S&P 500 index, like SPY. How long would it take her to acquire the first $100,000 if we assumed a 10% average yearly return? It takes 11 years. In that time period, she has invested $66,000, and her investments have grown to $111,000. She wants to keep investing, and is surprised to see that it only takes 5 years to reach the $200,000 mark. After 16 years, she has invested $96,000 and has a balance of $215,000. 3 years later, she will surpass $300,000. It will take Jill 31 years to have a balance above $1 million if she keeps up with this pace. Derek has a different approach. He wants to double down, invest $1,000 a month, and live frugal until he reaches $100,000. After he hits this goal, he will not add any funds, and the investments will only grow from the profits he can generate with his investments. He chooses, like Jill, to invest in an index fund tracking the S&P 500 index. It takes Derek 7 years compared to 11 years for Jill to reach his goal. In that time, he has invested $84,000. 6 years later, he has assets worth $200,000, even though he stopped investing years ago. Who do you think got to the magical $1 million mark first? Derek will beat Jill by 1 year, reaching the million in 30 years. In this time period, Derek has only invested $84,000, while Jill has invested $186,000. Both Jill and Derek did a great job. They got started and lived frugally in order to reach their first $100,000. From there, the snowball effect kicked in, and compound interest does its magic. This is why the first $100,000 is so hard, and why the next is easy. In order to get your first $100,000, you need to get started. Start investing today, even if it's small amounts. Find ways to save money, even if this means you will have to live frugally with fewer luxuries. There are many different investments you can choose from, and if you're not sure where to get started, we will advise you to check out an index fund, tracking a broad range of stocks, like the S&P 500. In our next video, we are going to share more practical advice for how you can save up the first $100,000. Our inspiration for this video comes from Charlie Munger's advice. Find a way to save and invest the first $100,000 fast. Then keep it up until you reach $1 million. Once you reach your first $1 million invested, you can take the foot off the gas because you have a great nest egg with investments that will provide you with profits for years to come. We hope you have enjoyed this video, and if you have any question or comment, we love your feedback. We read all your comments. Have a great day, and good luck on your own investment journey.